Um, okay. Sorry. Anyways, I wanted to introduce you guys to our very special presentation because today we're going to talk to you about something completely unique. I brought with me our manager of FX options. You guys actually get to ask an FX options dealer a lot of questions about a product that to most retail traders is really unknown, which is FX options. But it could be incredibly valuable. And today we're going to talk to you about some of the very interesting, unique, and probably unexpected ways of how you can use options to make your trading much better in the FX market. So without much ado, let me introduce you to Justin Biebel, who is the manager of FX options. I, of course, am Boris Schlossberg, director of currency research for GFT and FX 360. And let's move on to the next slide here.
Important note. Trading off foreign exchange contracts for difference, derivatives, or other investment products which are leveraged can carry a high level of risk and may not be suitable for all investors. Past results are not necessarily indicative of future results. For Australia, PDFs is available at www.gft.com.au. Please read before making any decision to deal in GFT products. GFT is the issuer of these products. The content hereof is available or accessible for informational purposes only and is not regarded as an offer or solicitation to deal in any investment product or to enter into any legal relation. Each investment product is offered only to and from jurisdictions where solicitation and sale are lawful. The information provided should not be relied on as a substitute for extensive independent research, and all trades should be considered taking into account your personal trading strategy, including risk tolerance before any trades are placed. Any projections or views of the market provided by this presenter may not prove to be accurate, may not be represented by GFT, its owners, officers, agents, or other employees. GFT will not be responsible for any losses incurred on investments made by a client as a result of any information contained in this presentation. GFT and the currency research team do not render investment, legal, accounting, tax, or other professional advice, such as require the services of a competent professional should be sought. This presentation and its contents are the property of GFT. Any commercial use or distribution of this presentation without the express written consent of GFT is strictly prohibited.
Okay, guys. Let's talk about why. You know what? Hang on a second. I'm sorry. You guys seeing both the option screen and the okay, here we go. Let's talk a little bit about why we want to use options instead of just trading spot FX. There are really a lot of reasons for why you want to do this, but today we're going to show you two very specific strategies for why options make so much more sense than going outright spot in many ways. The first and foremost is that options allow you to take a directional risk without the fear of a stop out. And we'll I don't know how many times all of us in the spot business pick a direction, take a trade, get stopped out, only to watch the trade completely reverse into our direction, then go on to hit all of our profit targets. And this is actually much truer for somebody who trades on a longer term time frame, like on a swing time frame, than anything I ever know. The FX market is notorious for doing this, which is taking you out of your stops and then going on to hit your limits. One of the greatest things about options is that this is the one thing you can avoid. You can hold the position irrespective of what the price of the underlying is, as long as you have duration on the option, as long as the option doesn't mature. And sometimes what happens is you could have a move against you and then a move for you completely in your way and come back and make money on the position, something that you would have lost money on spot. The second strategy, and this is a really interesting strategy for a lot of you guys, is the ability to enter market at limit and get paid for it. A lot of FX option traders like to buy spot at a particular price. Let's say the market right now, let's say the Aussie is 106.50, and you say I don't want to buy it until it comes down to 106 or 105.50. That's my support level. Well, using options, you can actually create a strategy, and we'll show you how you can create the strategy that will allow you to enter into a position only if Aussie comes down to 105. But in the meantime, you could collect money even if it never comes in. Let's say it runs away, goes to 107, 108. You can still collect premium and make money even if the trade never comes into your direction. This is one of the coolest ways of actually taking advantage of options, and we'll talk to you a little bit more about that as it progresses. So let's move on to the next slide, Justin.
So why don't we we'll take a look at what Boris is talking about. All right, can you guys see the trading platform now? Okay. So a couple of weeks ago, we're taking a look at a Euro chart here, and to go into what Boris was talking about, we have this nice trend line here, and if we were thinking about entering a short position in spot right here at the top of this trend line, put a sell in at about 32.80, and think about putting a stop about 100 pips higher. And as we watch time unfold here we go. Okay, so here's our entry, and immediately blows through, and you're stopped out 100 pips higher. And as time goes by, here it comes right back down again. And yesterday we had an opportunity to actually trade about 180 pips below what our original entry would have been, but we were out of the trade already because we just had that quick flurry up, and it took us out of our spot trade. Now instead, if we decided to use an option, what we could have done is taken a look at our option quote board here, and on the right here we have the 131 put that expires in about 41 days, and this is our order form here. If we were to put this put on 23rd on the same day as we entered our short spot position, it would have cost us about 100 pips. And when this market rallied up from 32.80 up to 34.50 or so, we would have been taking a floating loss on our option, but we would still be in this position, knowing that the most we could lose is that 100 pips. Then as the market sold off, came back down to our entry level and even 150 pips below, we would be in a position to either be, at least scratch and probably up on this trade. And, we actually ended up hitting our target at about 131 even yesterday. So this little, random bit of volatility that we saw to the upside that quickly reversed, it took us out of our spot trade, but had we done the option instead, we'd have the durability to stay in and actually exit that trade for a gain potentially. So I'm going to hand this back to Boris, and we'll move back.
One of the cool things that Justin had showed you, I think, is the asymmetrical aspect of the options trading. The first two things that you see in this particular example in the euro is that you're not taken out of the trade when it goes against you. You get to sit around and hold the position, unlike spot where you're just basically in position, right? However, this is the you don't have to wait until expiration to take advantage of them. So, for example, yesterday, right, when the option really dipped down low and you were, let's say, plus 100 in profit, you could have taken the profit live, in the marketplace. This is the great thing about the GFT options platform is that you're not obligated to hold these things all the way to maturity. So you get the best of both worlds. You have like 30 or 40 days to see if your position works out, and then in a day or two, when things move your way and you think and you can take advantage of the market, you get to take advantage of the market and get to lock in your profits. So that's the really cool thing about the asymmetrical aspect of options that I kind of just want to emphasize. But there's more to it, though, right? It's not that if everybody could just buy options and make money, it would be very, very easy. So maybe you can just tell us a little bit more about some of the caveats and some of the important things that you need to keep in mind in order to trade this properly, Justin.
You're absolutely right. So, the way to think about this is that there's an opportunity cost with, the flexibility that you're getting with options. And one of the main things to consider is that time is always working against you when you own an option. and we can actually break the value of an option down into two different parts. One that we call intrinsic value, and the other we call time value. Intrinsic value is going to be the amount an option is considered in the money, and for calls, that's going to be the amount the strike price is below where the market's trading right now, and for puts, it's the reverse. So it's the amount the strike price is above the underlying market price. And when we look at an out-of-the-money option, the entire value of that option is all time value. So, as the saying goes, time is money, and really as each day passes and expiration gets closer, the time value of that option goes down. And when we look at the put that we were talking about in the last example, let's bring that back up. So if we look at that put that we paid 100 pips for, a couple weeks ago, on our order form here, we have this Greeks tab where we can see some of the risk profiles of what this option looks like. We can see that this thing loses about 20 euros a day as each day passes. And if we don't get the market movement that we need, we're just going to have this option decay on us, and eventually this thing can expire worthless. So this is really a race against the clock. If we want to stay positive on this trade, we need euro to keep falling, and it needs to fall faster than this 20 euros a day that's coming out of the option. So if we hold on to this option until expiration, we would need it to be actually 100 pips lower than what our strike price is. So we have the 131 put, and here on our analysis tab, you can see that our break-even price, if we were to buy this option right now and pay 140 pips for it, we actually need euro to retrace down to about 129.60 for us to break even. So, it's definitely not a free lunch, and we do need market movement, and that's always going to be the case when you own an option. And like Boris said, you can always exit the position before expiration if you get up on the trade. We're streaming a bid and an offer on everything we put out there, so you don't have to feel obligated to hold this thing until expiration. All right, Boris.
Okay. So you mentioned that the option expires, but maybe you could explain to us a little bit about how the expiration date factors into option trading. What are the key things that every trader must consider when they're trading options if they want to have a reasonable chance of success in this particular instrument? Can you give us some ideas?
Sure. I would say there are three main things to consider, and that's going to be direction, timing, and the magnitude of the move. So when you put your trade idea together, ideally a trader is going to want to select an expiration date that gives them enough time to let that trade idea unfold. And it's a careful balance between, if you're buying an option, that you're actually buying enough time to let that trade idea unfold, and whenever you buy something, you've got risk capital that you're tying up. So it's a balance between how much time and making efficient use of your capital. Now, longer dated options are always going to be more expensive than shorter dated ones, and they're going to tie up your equity longer the more you sit in that trade. And if you're on the short side of that option, it's going to tie up your margin for a while. So the flip side of that is that you're going to have more time to let your trade idea unfold. So we can kind of see how this looks in practice. We'll flip back to the platform here. Take a look at our second example. And what we have here are two order forms. One with an option that expires in 27 days. You can see it's a 133 put in euro that expires on April 4th. The other one, let's match up these strikes here. 32 put with a 32 put. Okay. So this one expires in about 4 weeks, and this one expires in about 3 months. And when we look at how these options are going to behave, we can see that the shorter term option, even though it costs less, the value of that option theoretically is going down at a faster rate than our longer term one. So this one's losing about 22 euros a day, and this one's losing about 14 euros a day. So you're going to pay more for this longer term one, but you're going to have more time to let your trade idea unfold, and you're not going to lose as much in decay as each day passes. So that's how time can impact your position. And Boris, I'll hand it back to you.
Okay, time is only one factor, but there's two other, in many ways, very important factors that drive options. I mean, time obviously is very critical. And generally, the rule of thumb for me, at least, is that the longer the more time you give yourself, the better chance you have with options of success. The shorter the option, unless you're betting on a very specific event that's going to have massive movement, the shorter the option, the more dangerous it is for the end user. But let's take a look at the other two factors that drive option pricing. Could you explain that to us?
Sure. So we're talking about direction and magnitude here. So, direction, obviously, you're referring to your outlook. Are you bullish, bearish, or neutral? And, unlike spot trading, where you would end up being on the sidelines when your outlook is neutral, you can actually structure option positions that are going to pay off for you in a quiet, low volatility, directionless market. And, we're not going to cover a specific example of that today, but perhaps in a later webinar we'll talk about some of those strategies. But going to magnitude now, we're talking about the size of the move that you're looking for within your relevant time frame. So when you buy an option, it's just important to consider that you get enough movement in the underlying to pay for that purchase. We looked at what your break-even price would be on one of those euro puts, and it's important to buy it when you're buying an option to make sure that whatever you pay, you're going to get out of the underlying market. Now, on the flip side, when you're selling options, you want to make sure you're compensated enough to weather the volatility, and it's just a careful balance between choosing the options that incorporate your outlook, along with folding that into the amount of movement you're expecting in the currency pair. And to get a sense of what volatility actually does to the price of an option, we can look at two different straddles, one in Aussie versus dollar and one in Euro versus Swiss. So let me switch over. Okay, so here we have on the left side we've got Aussie versus dollar. We're looking at an at-the-money straddle, which is going to be a call and a put for the same strike and the same expiration. And on the right we have the Euro versus Swiss, and we're looking at the same expiration date, and we're also looking at the at-the-money straddle there. And what we can see is, we go to our quote board here. I'm not picking up prices right now for whatever reason. So with Aussie versus dollar at 106 right now. There we go. So with Aussie versus dollar trading at 106, we can see the straddle is going to be the call and the put together. So that's going to cost about 260 pips right now. And when we compare that to the Euro Swiss straddle, we're looking at a cost of about 150 pips. So we have over a 100 pip difference in the price of this straddle, and the reason is that Aussie versus dollar has a much higher volatility than Euro versus Swiss. So there are going to be times when 260 pips could look cheap, and 150 pips could look expensive. It all just depends on how much volatility you're expecting in the marketplace. So, these are dramatic price differences between these two currency pairs, and you can see that the threshold to break even on your Aussie dollar straddle versus your Euro Swiss straddle is a lot different. So Boris, I'll hand it back to you.
This is a really, really important point that I think everybody who trades options needs to appreciate. As Justin said, sometimes 260 points is cheap and 150 points is expensive. And it all depends really on how wide you think the currency pair is going to move. I mean, think about this. Aussie dollar could move 150 points in a day. It could easily move 300 points in a week. It could move 500 points in a month. So if you're paying 250 and you get a 500-point move, you're still in the money. Euro Swiss, on the other hand, has basically moved 100 points over the last 10,000 years, right? It's been the most glacial currency in the world. So unless you think, for example, that Euro Swiss 120 cap is going to break, unless you think the S&B is going to get rolled over, unless you think the euro is going to fracture, then that's not necessarily a great bet. And that's one of the key things I think you need to understand, is that whatever the prices the market is giving you, that's not necessarily the right bet. Where the profit lies is in your analysis of what is the most likely scenario given the prices that the market is giving you. That's really the critical thing of when you're looking at pricing options and making option trades. So I'm going to hand it over to Justin now, because I think he wants to show you, why you want to use options instead of spot FX for another reason, because of their inherent capabilities. Go ahead, Justin. Hi guys, did everybody hear me? Does everybody hear me okay? I'm going to take a few minutes to maybe answer a couple of questions that you guys may have about the platform and a couple of other things. One of the questions that people had here was, isn't the profits in options limited? Quite the opposite. If you're long an option, it's unlimited. In other words, if you bet, you say I buy a call in the euro dollar at 130 and it goes to 150, 155 in the time that it expires, I get the value of all of that appreciation. If I sell an option, then yes, my profits are capped to my premium. But if I'm long an option, then I obviously can take this. Somebody's asking if you can paper trade this with options on the GFT side. Yes, you can. We at the end of the presentation to show you the options demo platform, and you could definitely demo this thing. The options platform is actually far less complicated than you think, Joseph. It's incredibly relatively easy to lay out. It shows you the instantaneous quote of the underlying market, and then it shows you does it work on the Mac? I don't think it does. I think it's it's not a Java-based platform. It is a PC-based platform. I'm not sure, Joseph, if we have an options-based web-based platform. Hopefully we do. We can I'll be happy to find out, but it's definitely a Windows thing. Let me see what other questions we have here. Does GFT still offer futures? I'm not sure about whether we offer futures at this point for North American clients. I think we may have stopped doing that. A question is, do we have to worry about the currency being called back before expiration? That's actually a great question. No, generally you don't. This is it's called European expiration, so I think they can only call you at the expiration. Just remember though that one of the cool things, or one of the bad things, depending on how you want to view it, is that an FX options trade actually expires into the underlying. This is the key thing. It's not like let's say you bought Euro 130, you paid 100 pips for it, it's 132. So you have 100 pip profit, right? You paid 100 pips, there's a 200 pip profit, so 200 minus 100, you get 100 pip profit, right? It's not like you get 100 pips in your account, whether it be, $100, $1,000, $10,000 a pip, whatever you want to call it. It's, what you basically do is you get to own Euro at 131 on Friday or on the day of expiration. And if the market is 132, then you can actually sell the Euro, sell the underlying spot at 132. So that's one of the interesting things about the way options work, is that you actually, it expires into the underlying. It does not expire into it doesn't net out the profit for you. You then actually have to go out there and book your own profit if you want to wait for expiration. Most people, frankly, don't really hold the option to expiration. I mean, this is the key thing that I was trying to tell you earlier. The cool thing about the option is that you can hold it through the negative volatility, through the time when it goes against you, and not be stopped out. And then if it turns and goes your way, you can sell it at market any time to the dealer and, book your profit. And at that point, you're booking just pure pips. You're not even worried about the underlying. So most people who speculate in the option are doing it really before expiration time and before it comes in. So let me see if we have any more questions here on the options questions. So another great question. Andy is asking a very, very good question. This is a super great question and something that that most people really don't appreciate. He says, I think spot traders need to learn options so we can hedge, especially for position trades. What entry-level books do you recommend? Is that you're so absolutely right. One of the great things about options, right, is that if you go long Euro and then you buy yourself a put, you buy yourself essentially a hedge to protect your position, then you don't have to put a stop on your underlying. You don't have to put a stop on your spot, right? It's the same thing essentially as holding just the option position, because the option will protect you. So let's say for argument's sake, I'm long Euros right now, 132. I buy a 132 put, right? And then, tomorrow the Euro drops to 130. By Monday it's 129. And then a week forward, it's now trading 132, 133. Now, because I'm holding the put, I can always put that option back, let's say for a month forward, at 132. So I don't have to worry about the fact that the underlying went down 300 points against me or 400 points against me. I am protected to 132. I paid the price of, let's say, 100 pips. I'm just giving you examples. And that is what gives me the protection. Options are both a speculative instrument and an insurance instrument. Now, typically, almost everybody looks at them as a speculative instrument, but you're so absolutely right, Andy, that if you're a positional trader, it's one of the greatest insurance instruments there is, because what it does is it allows you, the peace of mind that you don't have to worry about, oh my God, Europe is going to crash tomorrow and my long position, which doesn't have a stop on it, is going to go down to zero because you've bought insurance. As somebody who just bought a ton of life insurance, I can really appreciate the value of the product. So, let me just turn this over back to Justin because he's back, and I know we've got a little bit of limited time, and we're going to show you one other strategy, which I think is really, really cool, and then we'll take some more questions. Go ahead, Justin.
Okay. Sorry, everybody. I just completely lost my computer there and had to reboot and start from scratch. So I'm not exactly sure where Boris took you guys while I was gone, but one thing that I was hoping to show you was this trade here in Aussie dollar. As we can see, Aussie's been on a pretty steady uptrend since December, and if you felt that channel was going to hold for a while, and you wanted to enter on the long side at the bottom end of that channel, we could take a look at this. And right now, this channel is rising about 50 pips a week, and if we look at an option that's about a week out, so that would expire March 14th on our platform. You can look at this 106 put here. And if you were to sell that, you'd receive right now about 58 pips. And the way that's going to work is if Aussie all right, that camera's on now. Sorry about that. So this put here is going to expire in about a week. And you'll collect 58 pips to sell that right now. And if that option were to expire out of the money, so that means if Aussie were to stay above 106, you'd simply keep that premium. And if you were to see Aussie dollar fall below that strike, you're going to enter on the long side. So you're going to buy Aussie at 106. However, you collected 58 pips or so to sell that, so your effective entry price is lowered by that 58 pips, so that takes you down to about 105.42. So it's kind of a neat way to pick your spot and enter the market on the long side or the short side. And if this strategy takes 3 or 4 times to get through, you can end up having a pretty meaningful impact on your eventual entry price. If you're collecting 50 or 60 pips a week to wait for the market really to come to you, that's not a bad thing. So, the flip side of this is that you're not going to participate on all of an up move. Your max gain is going to be capped here at whatever you receive. But in the meantime, you're profitable as long as Aussie dollar stays above your strike here. So if you were planning to buy Aussie at 106 anyway, why not get paid while you're waiting for this to happen? So, Boris, I'll hand it back to you here.
This is a very, very important example. I'm going to go through this one step by step. But first and foremost, Infernal Magnet. I love that handle. Jesus. A little dark there, Infernal. He is asking for a very good point. I think it was him. Maybe it was somebody else in the room. Somebody is saying, hey, it was Just Trade. So can you explain me the basics? I don't really know what a put call is. I don't know what Greeks are. I don't know what theta is. I don't know what Vega is. All those things. Great question. And you know what, Just Trade? I think what we're going to do, and we plan on doing a lot more of these FX options webinars with FX Street down the road. We're going to have like a basic webinar that explains all the key concepts and maybe even explains some of the key things. I'm just, maybe Justin and I will just do a walkthrough of how do you price an option? What is a put? What is a call? What are the Greeks? For those people that are looking just for the basic information, because it's very, very important. A lot of times, we kind of assume that everybody understands what all the underlying drivers of the options are. But today, I kind of just want to focus you back on the philosophy of this particular strategy, because I think this is the coolest part of what we wanted to show you. So Justin just showed you Aussie dollar, right? And here's the thing. I'm bullish Aussie dollar. Let's just let's say I'm a spot trader. I'm bullish Aussie dollar. I think every pullback is a buy because I think the thing is in a long-term trend. I think risk continues to go higher, right? So say I want to be a buyer Aussie dollar when it pulls back to its 100 SMA at 105.50, and it's trading 106 right now, right? So what can I do? I can sell the 105.50 put, right? And I can collect 50, 60, 30, 40 pips, whatever it is, let's say for the next week forward. And remember, the whole key thing here is that I'm already committed to getting long this position. So if the thing comes down to 105.50, I've bought it. But here's the difference between me and a spot trader. As an options trader, when I buy the 105.50, I'm already made 40 points of profit because I've gotten 40 points of premium, right? I don't think Justin has a chart up right now, so that's why I'm just extemporaneously. I just want you to understand the underlying sort of structure of this product. I'm already ahead of the spot trader by 40 points because I'm a buyer at 105.50. Same thing as the spot trader who wants to buy at support, but now I have 40 points of premium. That's scenario number one. Now the thing comes down, let's say down to 105. The spot trader is down 50 pips. I, as an option trader, am only down 10 pips because I got 40 points of protection that's basically keeping my P&L in my direction, right? Now, if I'm completely wrong in the position, and let's say it goes down to 103 and I'm stopped out, great, I'm stopped out. I would have been stopped out on the spot. In the spot scenario, I'm down 200 points. In the option scenario, I'm down 150 points. Let's just say it's a 50-point premium. So now, in both situations I've lost, but in one situation I've lost less money. And we all know that the key to success in trading is not about how much you win, it's how you minimize your losses, right? So if on a situation where I'm completely wrong, right? In one situation I drop off 200 pips, and in the other situation I drop only 150 pips. I'm actually way better off because now I only have to make up 150 pips on my next trade instead of making 100, 200 pips just to get back to even. Now, in a reverse scenario, it comes down to 105.50, right? And it does the perfect thing, which is it comes in there and then bounces right back up, right? So now I'm the same way as the spot trader. I bought the thing at 105.50. I own 40 points of premium. It bounces back up, so I'm able to participate in the whole move back up. And now let's say we cash out at 107.50. In the spot situation, I've only made 200 points, 105.50 to 107.50. In the options, I've made the 200 points, 105.50 to 107.50, plus the 40 points of premium, right? So now I'm up 240 points on my options account. So let's take a look at the two scenarios. In the spot scenario, I lost 200 points, made 200 points. In the option scenario, I lost 150, made 250. Man, those are pretty damn good odds. If I could do this all day long, I'm happy as a pig in garbage, because I have now just put the odds in my favor by essentially creating the exact same strategy using options that most of you guys use in spot, which is buying at limit. You know, most guys like to buy it in limit. Yeah, pig and poo, exactly. Thank you. I was trying to find the right alliteration, trader. So now we have that situation. Now the third scenario, which is kind of cool, not as great as the first two, but still pretty damn good. So in spot situation, I want to be a buyer 105.50, but Aussie never comes into 105.50. Let's say it drops down to 105.75 and then takes off like a rocket, going up 200 points, and it has a big rally exactly as I expected, but never comes into my price. What have I done? I've done nothing. I haven't made any money, right? Because I haven't gotten triggered on my limit trade. As an option trader, hey, I've collected 40 or 50 pips in premium. That's not so bad. Even if I never got to execute the trade, I'm still collecting money. So you have these three scenarios. In one scenario, I've lost less money than spot. In the other scenario, I've made more money than spot. In the third scenario, the spot never even got to play, and I got to play by collecting premium. So it's pretty cool, right? I mean, I think that's really one of the coolest things about this kind of a strategy that puts, hopefully, the odds in your favor and allows you to buy options. That's the other great thing, by the way, about FX options is there's no commission. It's just spread-based like spot. And maybe Justin, if you could, I'm gonna turn off my mic. Justin, if you could just show them a little bit about the window and how where the prices are. And where the quote are, so they can see what are the actual spreads, because you'd be surprised at how tight the spreads are. The spreads are no more than 3 or 4 pips between the buy and the sell of the option. Let me just turn off my mic and let Justin just show you lastly how the platform looks.
Okay, thanks, Boris. All right, so we got a couple questions there. What does it cost to open an account? And actually, I'm not sure right now what our account minimum is, but that's going to be on our website. There's no fee to open an account. There's just going to be an account minimum. And to address what Boris was talking about, spreads on our options are gonna vary from pair to pair. Our tightest spreads are going to be in euro. Just like on the spot side. If we look a month out, we've got spreads that are 4 point something wide on euro at the money, so that's pretty good. If we were to look at one of these Aussie spreads that he was talking about, here we are. If we wanted to do a put vertical, say it's the 106. Against the Actually, let's look at a shorter term one. That's what we've been talking about here. 6 against 103. Okay. So here's what we're talking about. If you were to sell this 106 put, or actually we're talking about the 105.50 put. If you were to sell this 105.50 put and collect your 35 pips here, you are opening yourself up to, that potential unlimited downside there, like you would in a spot position. But what you could do is buy a put that's further below.
Justin, sorry, we don't see the window. You need to see if you can give us the window.
Okay, it looks like the camera must time out. So, can you see the form now? Okay. So we have the 105.50 put against the 103 put, and if you were to sell that 105.50 put for 34 pips and pay 7.4 for this 103 put, you're collecting about 26 pips total, and you're completely capping your risk there at about 225 pips. So you're looking at a fixed risk scenario here where no matter what the market does, if Aussie absolutely falls through the floor and goes down to 101 or something like that overnight, you're stopped out because you've actually bought a little bit of insurance here by paying 7.4 pips for this other put down below. All right.
So Justin is just going through a couple more screens. We're going to have to wrap up the session. Let's see if there's any more final questions. If there aren't, what I wanted to do, Justin, I'm going to let Justin sort of wrap up the session here. But obviously, I hope we've sort of whetted your appetite on the options question. We invite everybody to just give GFT a call and ask the desk about the various base account minimums and stuff like that. Because obviously, Justin is on dealing and I'm on research. We don't know any of those questions. But at very least, you can download the demos. You can play around with them, and we will certainly have a lot more of these type of webinars for you guys. And I think even if you practice these ideas on a demo, you'll be able to understand the incredible value and the incredible power that some of these strategies can have in your arsenal of trading. So I'm going to turn this over to Justin and see if we can wrap this up for you guys.
And thanks everybody for joining us today. I do see a couple of questions out there. GFT right now does not offer any exotic options. All we have on the platform right now are plain vanilla, and we offer them on about 13 different pairs right now. What else do we have? Question from Money Magnet: can you roll your options at GFT? The answer is yes, you can. Right now, you're not going to be able to do it from a single order form, but what you are able to do is issue a closing order for the option that you're in and immediately send in an order for the option you want to roll into. If you're worried about the market moving while you're handling that roll transaction yourself, what we do have on the order form, and I'll switch back over to the platform here real quick. What we have in our order form is this one-click hedge function here. So let's say you wanted to roll this 106 Aussie call from April 4th, out another month. You can click this hedge function here, and when this option gets executed, you're gonna get this spot hedge at the same time. So you're not really taking any directional risk while you're building your order form for your second roll transaction. So hopefully that answers your question. Let's see. We have another question here. Does GFT take the other side of clients' options? Our relationship is always as a market maker with our clients, so technically we are always your counterparty, and that's really how the account setup is set up, and doesn't matter really how that relationship, how we handle the risk from there. We are technically and legally bound to be the other side of the trade, and we're always the counterparty. All right, do we have any other questions? One other one. Are all trades put into the real market, from Philip? And, the nature of the Forex option market is that it's OTC. So, transactions are happening, at all kinds of counterparties all over the world, and there is no, central clearing place for these right now. But it's a very competitive market, and you can do pretty extensive price discovery out there. And I can guarantee you that if you put a bad option price out there, whether you're a bank or a trading firm like GFT, that somebody's going to be watching it and keeping you in mind. So, to say, are the trades put in a real market? I would say the answer is yes. You have to put good prices out there, otherwise you're not going to be competitive. All right. Is there anything else? All right, Boris, I don't know if you have anything else, but I'll hand the mic off to you for closing, and thank everyone for joining us today, and I look forward to doing this again in the future.
Thanks, Justin. Thanks very much. Note the trader, not all brokers accept option trading. Option trading is actually very new in many ways to the FX market, the retail FX market. And one of the great things about us is that we have probably the easiest, most comprehensive platform to trade options, which is why we kind of wanted to show you. And of course, the great thing is that we are going to make Justin, who is the primary dealer for options, he comes from the CBOE. He's been a market maker on the Chicago exchanges for a very long time. An incredible resource to all of you guys. And as you get comfortable with it, we'll be happy to trade, to do more webinars where we'll be, you can share your strategy ideas, your pricing ideas, and we can offer you some insight as to what makes sense, what doesn't make sense. But here are the key things about FX options with GFT. With 24-hour access to the streaming option quotes, right? We stream everything from CFDs to spot and FX options. We have very much the exchange style look and feel of it, which means that it's all standardized. It's typically standardized to 10,000 units. You can go to 100,000 to 1 million units, whatever. It expires from 1 week to 6 months. So very standard expiration. And it supports all sorts of various option strategies. Somebody asked here a lot about exotic options. You know what? Trust me, there's so much variation you can do with normal options that you can easily just simply use our platform. We got to get out of the room, guys, because we obviously ran out over time. So I'm wishing you the best of luck, the best of trading. Come back and we'll do more option webinars with you sometime down the road. Have a good one. Take care.